Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. And today we're talking about another stock. It's another coal stock because the coal stocks have been getting crashed. And that's when I like to take a look at things. So talking about a position that technically is part of the eToro portfolio, although it's barely worth mentioning, it's very, very small, looking to build it out potentially over time. Peabody Energy, going to be my stock analysis. Let's get straight into it. Disclaimer, nothing I say here is financial advice. Please don't misconstrue anything I say as advice. I'm not qualified to give advice. This is just my opinion and what I am doing. You need to be responsible for your own decisions and their potential consequences. So with that being said, if you are looking to leverage this beast a little more, there'll be a link in the description to the options Mavericks. On this particular stock, Peabody, I show you an options trade I'm making that would potentially allow you to buy the stock at over $1 cheaper than what it's currently at. And it would mean on expiry that you'd get a return on your investment of 1.86% per week, which is pretty good. So you can try that for free for 7 days, typical Substack stuff. You know the rest. You can see the track record of the trades. Currently, we're doing just a little bit under 6.5% per month. So yeah, I'm very happy with it. So I show exactly what I'm doing. There's no theory. It's just me. There's no advice, of course. It's just me doing what I do and sharing it. That's it, over the shoulder view. Nothing else needs to be said. So today, trying a different format for the one pager. A ticker terminal have this new structure on their platform. So I thought I'd screen grab it and put it on. This is Peabody, a one-page snapshot. We're very close to the 52-week low. And I guess what's noteworthy about this from a quick glance is that Peabody's balance sheet is so much better than it used to be. They've made monster cash flows over the last couple of years with coal prices being so high. And why is that? Well, we had supply disruptions at the same time that we have, let's say, a shaky transition to solar and wind being used as main energy sources, and they're not quite ready to power a grid, shall we say. At the very same time all this is happening, we are having increased demand from emerging markets, increasing population and hitting their S-curve of energy consumption, and coal is still what's carrying the team there with that regard. So enterprise values come down a lot because they pay down basically all their debt. They've got no net debt, so they've got a positive cash balance on the balance sheet, and that's important. So when you're looking at, I think the closing price is $18.16. That's the market price, but how much cash do they have on the balance sheet? If you work it out on a per share basis and then minus that off the asking price, which is the quoted price on the public stock exchange, you're looking at about $15 is the true cost for the ongoing operations of this business. Okay, so when you pay the price asked by the market minus the cash that's in the bank account, the corporate bank accounts of this company, that's what you're looking at. Last 12 months, all that, I guess, capital efficiency ratios look really good because of the coal price. Okay, so it's a little bit misleading there, but they're still pretty good. I would like to point out this. So price to book value is less than 1. That always gets me at least interested. Doesn't mean I pull the trigger straight away, but it certainly gets me interested. EV to EBITDA at 1.5. Interesting. This is what people have a target price on at 29. We're going to talk about my analysis, my target price, market cap to free cash, estimated that your current market cap, okay, so 16, excuse me, is paying about 2.89 times the free cash flow. Meaning that the market expects this business, the cash flows, to be valued at 0 in 2.89 years. So we need to ask ourselves, you don't have to, I do. Do I believe the business is going to be extinct in 2.89 years? And personally, I don't, for reasons that I've spoken about ad nauseum. So in a nutshell, what's the thesis? We got a coal producer here, and I've been talking about them recently. I haven't bought a lot. I'm just nibbling. And it sells various types of coal. So it's not just thermal coal for electricity generation, but it's got different coking coal and metallurgical coals that's used in industry. And so I believe at the moment, the prices have come down because people are afraid of a recession. If we have a recession, we're going to have less need or perceived needs for steel production, industry, manufacturing, all that sort of stuff. And yet at the same time, how are we going to build all these wind farms, wind towers? How are we going to build electric cars? How are we going to build infrastructure for politicians, promising these bills to get into power? I think we're going to need a little bit of steel. And I'm a big fan of Horizon Kinetics work, and they believe that steel is, out of all these things that we're going to need, steel is going to be the big one. And I say to myself, okay, well, I own some steel. How do you make steel, and what's the input? And so at the same time, if we've got coking, met coal, all that stuff coming down, maybe I want to take a look at owning that, because if there's going to be, if steel's going to be a end product of that, let's say, maybe this may turn out to be a better bet. Who knows? So there's not much competition because everyone hates coal. Why? Because they've been told to hate coal. End of story. Recent sell-off on the verge of increasing demand, as I mentioned, in an already supply-constrained industry. Difference between here and, I don't know, 4 years ago is that the balance sheet is far deleveraged. Question mark around the margin. So if we do see a real crater in the coal price, it won't be great for these types of businesses. So can they survive? Well, we look at what the cash on the balance sheet is like. And if we can buy that at a discount to book, and they've got the cash to get themselves through any rough patches for, who knows, 2 to 3 years, it could be a good time to scale in and enjoy the happy times, or expected happy times, on the other side of that curve. That would be the thesis. We'll see how it plays out. If we're looking at coal, if we're looking at Newcastle coal, which is where you'll see in a moment, a lot of the unpriced product will be priced at. They'll also be using hard coking coal, which is a different futures. But for a quick look, let's see. Newcastle coal shot up on the back of expensive gas prices, and so people turned to coal. And now we've had this cliff dive. We're back roughly where we were mid-stage 2021. Before that, we're all the way back around sort of 2011 in terms of where the coal price is currently. Since 2011, though, what's happened in terms of CapEx into this industry? Big decline, dearth of CapEx. So we're going to get to the stage where either there's not going to be the coal availability to supply even just the emerging markets. And I know there's going to be a decreased or projected decreased demand for OECD countries. I get that. But the old Jim Rogers play, where if you look at something, and even though you've got a declining demand story, if you've got a supply story that's so constrained that you may be scraping the barrel, and he talks about this with lead as an example in the late 80s, I believe, in one of his books, you're still on a good thing. Why? Because if you just can't get the stuff, but it's inelastic in terms of its demands, and somebody, i.e. China, India, etc., really need that, you're going to be okay in terms of a price perspective. So I don't know if we go back to, $400 a ton, but we got to ask ourselves, if we just sort of hover around in here, will this investment be okay? And I talked about this with Yancoal. Peabody is a bit different in terms of its domestic exposure in the US. And I think that that's a good thing, because it makes up less of a percentage of the energy inputs in the United States. And they have Senator Joe Manchin, West Virginia, a very, very powerful senator who, let's just say, is disincentivized to hate on coal. That would be how I'd put it. If we look at a price chart for the company itself, so Peabody, where are we here? Before the pandemic to 2019, up at $40. Shot down around pandemic. I mean, if you got in at less than 5, congratulations, you did very, very well. And then obviously we had the energy constraint that was starting to come to the fore, and this company shot up. They were generating monster free cash flows. And then recently, as we've seen with the coal prices, it's dropped back. Okay. So that's that basically. So the price has come down, but the enterprise value is still pretty good, because they paid off all the debt. Basically, they got a negative net debt. From the quarterlies, this is management talking about full year guidance for 2023. There's a few holes missing. I find it a bit difficult to fill in, but I've done a quick over the back of the envelope. So we look at their volume and what they've already priced in, and then what their average cost would be. And it's a very, very rough back of the envelope in terms of them. The profits there. And then I just wanted to reiterate that 45% of their unpriced exports are expected to price at that Newcastle level. 55 expected to have higher ash content and price at maybe 80 to 95%. of the API 5 levels. So yeah, you can take a look at that. There's a few moving pieces in a company like this because they don't just sell the one product. So it does make it a bit trickier. And what I've done is I've taken their overall numbers and I've smoothed them out over the good years and the bad years, which you'll see in a moment. If I just take analyst estimate for free cash per share and EBITDA per share, and I apply a market cap of 2, or a multiple of 2, and an EV to EBIT multiple of 3 for the EBIT, we get an implied target price of $17.54 and $28.77 dollars respectively, and an equally weighted average of 23.15. Now, if you took the market cap or the share price asking 1865, that's about a 24% upside at the moment. Suggested that's embedded in the price. But actually, the real price, if you want to look at it that way, for the ongoing operations of the business is more like $15. So if you take the enterprise value and you divide it by the shares, you're looking at about $15. So there could be a decent upside already. Then here's something else I wanted to point out. So if I dig in a little deeper, if I go way out in terms of the tax rate and increase that a lot, and if I use a 10% discount as opposed to the 8%, which would be their their weighted average cost of capital, and I only use a 1 multiple for EV to EBITDA, meaning the market doesn't apply any premium to the business. It's just valuing cash flows and essentially saying the business is going out of business in 1 year, more or less. Here's what we look at. Okay, so these are the assumptions. You can look at them in your own time, or you can use your own assumptions. What I've done here, which I would just like to point out, when looking at the EBIT, smoothing out analyst numbers, and then saying to myself, well, what if this business really does decline a lot over the next call it 4 to 5 years? Okay. And so what that would mean, I've assumed that their EBIT, their operating income, is going to decline at a rate of 15% per year, okay, which I think is controversial. I don't think that's going to happen, but for the sake of a what if, here's what I've done. All the rest, so CapEx has been done at management level, and then we've looked at changes in net working capital I've done as the average of the last 5 years. Okay, so it'll be obviously won't stay the same every year with cash balances changing, but it's been smoothed out. We get an estimated intrinsic value, if you believe these things to be true, and if you use these assumptions, of $29.22. Okay, so we've got an upside of $10.72 from where we're at. That would imply a target upside of 58%. Okay, and then over a double-digit IRR. So $24 on the back of the envelope, $29 on the more fleshed out scenario. So it is consistent. So what am I going to do? I'm slowly, and I do mean that very slowly, accumulating. So I do own the stock. It's in very small quantities. I have owned it in the past and made a lot of income on trading options around the stock. And so I'm carefully dipping the toe in, and I'm trading a few options for a bit of fun. Okay. Waiting for a correction and crash. That may already have started. It may be bottoming out, or there may be further downside. We'd have to be getting fairly close to the downside, from $400 a ton down to 110. Surely we're getting close, but I don't know. So I'm keeping an eye out. I'm using the options market to help give me some margin of safety on my entry and make some income while I wait. If you want to know what I'm doing, click in the link below and I'll share it with you, and you can join the Options Maverick if you wish. Other than that, take care, guys. If you want to copy the portfolio, link in the description. Please do leave a like and a comment. And I'd love it if you would subscribe to the channel. Otherwise, take care, and I'll see you in another video shortly.